a global thinker, thinks of economies, thinks of the economic impact across the Asian landscape. Chetan Ahya, Managing Editor and Chief Asia Economist at Morgan Stanley, joins us on the show. Chetan, such a delight talking to you today. Thanks for taking the time out. Hope all is well.
My pleasure. Thank you for having me.
Well, I wonder if too many people can talk about pleasures these days, Chetan, considering that the news flow is so heavy from maybe the junction where you live in. And the interesting part is that now the news flow is coming with time extensions given in advance, as Donald Trump did yesterday. But how do you think of all of the developments in the last 3-4 months since Donald Trump has gone on this overdrive of making announcements, and gauge and hypothesize the economic impact on impacted countries, if you will, particularly in the Asian region?
Look, I think for the longest period that this trade tension story has emerged, what we have been highlighting is the most important implication from this development will be on corporate confidence, therefore corporate capex, and onwards to Asia's growth as well as trade outlook. So we still pretty much stick to that story. We've seen hard data points holding up as of now, but that is to be expected. And we'd seen that happen in 2018-19 as well. Initially, as tariff was being imposed, we did not see much impact on trade numbers or capex numbers. But after a period of 5 months, we began to see that impact come through. And we are building in something similar in terms of our growth forecast trajectory in this cycle as well. So I would say watch out for the damage that this trade tensions does to corporate capex and regions growth. It's still in the pipeline.
Okay. So Chetan, one would understand that corporates would be a bit skeptical about taking large-scale capex decisions, and therefore, would the baton of growth fall in on enhancing consumer spends as well as government capex in almost all of the Asian economies? Would that be the recipe, you reckon?
Yes, that's true, but it will be difficult for everybody to offset that kind of a growth slowdown that will emerge from this capex, private capex as well as trade, with just the government spending. Look, as far as consumer is concerned, it's going to be hard for consumption growth to accelerate in an environment where capex results into job growth slowdown, and therefore income growth slowdown for the households. So the only real offset that can be provided is with the government spending.
Okay. Chetan, good morning. Hiral on this side. My question coming to you is, the recent capex details that did come in the month of May are clearly telling you that India's private sector capex is at record high levels. How does this fit in terms of your analogy? And secondly, when you're expecting Asia's GDP to grow at a pace similar to 2018-19, the ramifications you saw then, and how are you relating it to the ramifications that could come in now?
So for India, the private capex number that you mentioned, that's the trailing number. What I am highlighting is that there will be a challenge to the private capex story. Even in India, yes, there are policy reforms being taken up, and therefore we should see India's private capex doing better than other parts of the region. Also, at the same time, India is less exposed to global goods trade cycle. So India should outperform other Asian economies as far as private capex is concerned. But there is still going to be some downside that even India will have to face on private capex as goods export slows down. And then on the second question that you had in how we are thinking about it, I did mention at the start that the framework that you have to keep in mind is that what trade tensions does is it affects the corporate confidence to invest. What happened in 2018-19 is that once you take the decision to not to take up new investment, it takes about 4 to 6 months before numbers begin to show that hard data points. Because in the initial period, you would be completing your past projects that you would have announced. But as time goes by, you will begin to see the impact on economic numbers with new investment decisions not being taken by the corporate sector. If you just think of it like any company in the US, if it was to set up a new factory, it would have to then think about, well, what material is going to be sourced from which country. But currently, with the way the tariff decisions are, it'll be hard for them to go ahead and make that investment decision. And so that's what will then filter through to global trade. And then correspondingly, we are going to see that in Asian corporate sectors decision making as well, that they will hold back the investment decision. And so you will see an across the board capex slowdown. That's what will then eventually show up in hard numbers.
Got it. Okay. Chetan, so yeah, would you reckon that what's the antidote to these growth challenges? Because it doesn't seem like the news flow and the actions from the US will change. They seem to be a regime that is looking at higher tariffs for multiple reasons. So if that isn't changing, what's the antidote to this?
So, for Asian economies, it's hard to really be able to offset this downside. They'll have to take some pain on the growth. But what they can do is to take up this domestic demand stimulus, which can come from both fiscal and monetary policy. Now, good news on monetary policy is that we are also seeing the dollar weaken. That opens up the room for Asian central banks to go ahead and take up interest rate cuts. As it is, because of the fact that there has been a slowdown in China, we've seen inflation coming off across the region. And now this trade slowdown will further bring deflationary pressures in the region. And so central bank will have the leeway to go ahead and cut interest rates, which we have seen. Central banks in the region are beginning to do that, but they can do more. And at the same time, we will see that governments will have to do some fiscal policy stimulus measure. So that will then additionally help defend this growth slowdown. Again, I think the problem for everybody, and we've seen that live in India as well, that post-COVID, public debt to GDP shot up, fiscal deficit had gone up. So governments around the region are not very confident to go ahead and take a big fiscal expansion. And therefore, we have been highlighting that heavy lifting will have to be done by the monetary policy as far as defending growth slowdown is concerned. This is slightly different for China. For China, we think that fiscal policy is going to do more heavy lifting because they are already running very low interest rates. But for Asia ex-China, including India, we think monetary policy will have to do the heavy lifting.
Okay, so Chetan, then can I focus a bit on India based on what you just said? So one, the new RBI and the monetary policy stance that it has taken and the moves that it has done. Part one, is that a shot in the arm? And two, the case for India, because there is a large dividend that has been given to the government, the GST collection thus far seem to be okay. Does the government have the wherewithal to continue with the government capex in the way it has, maybe try and spur consumption a bit and still be on track for the fisc glide path that it has laid out for itself? And the final encompassing thing is all of that enough for India?
Yeah, so we think monetary policy is definitely on the right track. We've seen that the RBI took the bold decision to cut interest rates by 50 basis points. We didn't expect it, but we think that was the right approach. And we expect more. So I think monetary policy is on the right track and it's doing what one would expect to defend the growth slowdown. As far as fiscal policy is concerned, look, I think the government has already been, if you look at the first 3 months data for this financial year, capital expenditure is growing at about 35% average. So that's pretty strong. And we think that the government has the room now, also because oil prices have fallen back again. And that can open up the room for managing the fiscal policy better, because the government can increase some excise tax revenues. They've already done one round, and then use that to ensure that they have enough funding available to do extra capital spending to defend this growth slowdown. At this point of time, we haven't heard many governments talk about taking up active expansion. But eventually we will see that more governments will talk about this, because there will be that support that will be needed, and everybody is just waiting for growth data points to actually come through. At this point of time, since growth has not slowed anywhere meaningfully, we have not heard much. But I think as growth data point slows, you will see governments talking about taking some fiscal support measures. And at the same time, we think central banks will also act in a more aggressive manner.
Chetan, so let's, talking about Asia and putting India into perspective out of this, you have been looking at the way Asia-US growth differential has been improving as well. I think, if I'm not mistaken, 35th consecutive year where you're running a current account surplus, right? Taking that into consideration, if you're expecting Asian currencies to see an impact given the weakness in US dollar, where do you place the Indian rupee, number one? And number two, from here on, would investments in India still be a better bet as compared to other emerging markets if you have to look at the China plus one strategy as well?
Yeah, so look, I think the dollar has been generally weak, and our global macro strategy team expects the dollar to weaken by another 6% by May of next year. And we expect that something that will basically result into a situation where all the currencies across the world will appreciate against the dollar. We expect euro and yen to appreciate a lot more. And as far as Asia is concerned, DM-like currencies, which is DM-like emerging markets in Asia, will appreciate more. And the EM-like currencies will appreciate less. So India falls into that last bucket. And we're expecting India to INR to appreciate by 3% by May of next year. 3.5%. And something similar will be the case for other EM-like Asian economies like Indonesia and Filipino peso. So yeah, that's the view we have as far as the currency is concerned.
Right. All right. Thank you, Chetan, so much for joining us on the show. Always a pleasure to speak to you and get your perspective in terms of what everything means for the global markets and in turn